tokenized US T-bills. This is a market that's gone from virtually zero to around $2 billion in assets in around 3 years. What's going on? Something's happening. Today, I'm joined by Martin Carrica, who is a founder at Mountain Protocol. Welcome back to Crypto Clarified. I am Benjamin Dean, Director for Digital Asset Strategy at WisdomTree. I'm really glad you came to join us for what's going to be a very interesting discussion. US listeners, wisdomtreeprime.com, Apple, Android app stores. Go have a look. If you're a US listener, hit subscribe and share on Spotify, YouTube, iTunes, wherever you have purveyor of quality podcasts. And then you can always find me on the Bird app, X, at Benjamin Dean. Before we begin the episode, I have to do the most thrilling part, though. Sam and James in compliance. This one's for you. Before I begin, I do need to state the following to clarify the views and opinions expressed in this podcast are those of WisdomTree and Mountain Protocol and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation or a solicitation to buy it or sell any securities in reliance upon them. Is at the sole discretion of the listener. Please remember, past performance is no indication of future results. All right, on to the fun stuff. Martin, welcome to Crypto Clarified.
Hey, Ben, how are you? Thank you for having me.
It's an absolute pleasure. You and I have spoken a few times, I believe, about tokenized T-bills. And that's a very interesting market. It's growing at what's becoming an exponential rate. But before we discuss that in depth, perhaps you give the listeners a feel for your background and the very interesting work you've done at you and your team at Mountain Protocol.
Awesome. Sure. So my background very quickly, personally, I'm from Argentina. That is what took me into crypto. How do I exit the Argentinian peso back in 2012? The only option there was either you would go and buy paper dollars somewhere or you would buy Bitcoin. We went through down the Bitcoin route. I worked most of my career since then in traditional banking. And in that, I worked with several high-yield checking accounts. And high-yield checking accounts for crypto people is an FDIC insured account in the United States where you deposit dollars, the banks lend that money out, but essentially they look at that as a source of funding and they pay you something similar to their cost of funds, which is around the overnight funding rate of the Fed. So what would be today a 5% rate. Those high-yield checking accounts were very successful until the 2020 COVID crisis when rates went down to zero, right?
Yes.
And the ZERP era came in. Before that, Marcus by Goldman was kind of like the marquee high-yield checking account. They grew to several $1 billion in deposits very, very quickly with almost no advertising. So an amazing business model. Many other banks replicated that model. And in 2022, when Luna collapsed, rates in crypto were zero, and high-yield checking accounts were starting to pop up again, I was, why am I not able to get that level of service on crypto if I can't get it on TradFi? Like, it should be the opposite. Like, crypto should be richer than what I can get in TradFi. Mm-hmm. And I started looking into the business models of stablecoin issuers, which they make a lot of money. I think now it's very well known, but it's money that you don't spend.
Tether is wild. They're more profitable than Goldman Sachs, and they've got like 50 employees. I don't mean to interrupt, but like it's wild how profitable some of them are.
So the question, and that many people are playing around is like, when would Tether buy Circle, right? Circle is playing, it's preparing for an IPO, ballpark $4 or $5 billion. That's what Tether made in the last 2 quarters. Will Tether buy Circle? Who knows? I think it would be very interesting to see that happen. But this is something that people don't pay. So most people are not aware of the cost of holding a stablecoin, right? Because it is money that doesn't come out of your pocket. But if we look at it as a system, the level of outflows from the system are comparable to ETFs, right? It is of the order of magnitude of a Bitcoin ETF. It is of the order of like way bigger than the Ethereum ETF. So the flows that are coming out from stablecoins are insane, right? So in 2022, we saw that. I started writing about it. I was like, as a person, I thought like someone must have solved this. Like it is not that complex of an idea. And after a couple of months of searching and trying to find this product, I couldn't find it. So I was like, okay, let me start working on it. I chatted with several people. Seb from Seb Deribot, who you had in the pod, was one of those early people who I bounced ideas with. And it turned out to be a lot more complex than I initially imagined, right? So creating a stable coin that feels like a high yield checking account is very, very hard, right? Like having a permissionless product is very hard, particularly on the regulation side. So that took us 18 months of work. So we started mid 2022. We launched our product late 2023, right? So a long period of time to do it right. In the middle, a bunch of other products launched in the market with a lot of trade-offs. And since we launched, kind of like the market had been educated in a certain way, right? So if you have 5% yield, you're a security, for example. I think that's not true, right? Like you can have security products, you can have payment stablecoins with rewards, and people don't question when they get 5% on Coinbase with USDC, but they feel like if you're getting a USDM, it's a security. So I think that's one of the things that our delay on launching miseducated the market. But in general, since we launched, we've become the most liquid stablecoin, yield-bearing stablecoin in the market. By far, today you can redeem north of $10 million of USDM for USDC, for example, with almost no slippage, right? Like 1 or 2 bips of slippage. So it is a very liquid product. And today, just prior to our recording of this call, I did a post for USDM to become collateral and compound. So hope we see that coming in soon. So yeah, a lot of exciting things happening with Mata Protocol.
Before we go into the why, and you've just alluded to the why behind tokenizing these assets and the complicated regulatory pieces in the background. Before we do that, we recorded the last episode of this podcast with Cami Russo, who joins us periodically to talk things over. I find it so fascinating that out of all places in the world, there are so many Argentines who, as you said, kind of naturally gravitate towards this. It's just fascinating to watch. And she was talking about the crecimiento plan. So anyway, that's one piece, which is like, there are so many Argentines who work on this and have worked on this for years and years and years, because there's a real need in the market using this new technology. Now, we can talk a little bit about which networks you've deployed USDM on. I assume Ethereum as a start, but we can talk about others. I'm kind of somewhat interested to know, and again, you've alluded to this, why would somebody want tokenized yield-bearing US dollar denominated or stable coins, which is a word I don't like, but like that idea, why would people want to use this technology in order to solve problems that they face?
Yeah. So before we go into that, and I think it's connected, right? Like, why is Argentina such a fertile ground for crypto founders and crypto in general? So Bankless recently released a pod with 3 of my favorite founders in Argentina. Go watch that
with Manu.
With Manu, Chelo from Lemon, and Fede from Buenbit.
Fantastic. I don't mean to interrupt, but like Manu, I picked ice up for him before when we had an asado, so I know.
Yeah, so he's fantastic, and I think that pod is really captures why Argentina needs stablecoins, and Argentina I think is an example of the rest of the world, right? So the US has, I think, an okay system, right? Like we complain about like ACH taking 3 days, you have to pay for wires, etc. But all in all, it kind of works. The rest of the world, you're working with local currency, which is very easily debased, right? And this is the premise for Bitcoin. But the issue of why I chose Bitcoin in 2012, but my mom cannot buy Bitcoin, is because of the volatility, right? Like if you make $200 a month, plus minus 50% is very significant for your savings. People have gotten used to holding dollars, and that is across the world. Now, if you're going to be holding dollars, why not hold dollars that pay you 5%? And that is a question that many people in the US have asked themselves, and that's why you see Robinhood have a cash account, Goldman Sachs release their own, and so on. But the rest of the world has the same question. Why not get that 5%? So that's why you would hold that kind of like 5% dollar. In the end, that there's kind of like where we see the market kind of like evolving is there's three ways in which you can hold a, you say you don't like stablecoin. I also don't like, I think it's crypto dollars is a better definition of stablecoin. So it's like a dollar, like a cash equivalent that's worth $1 in crypto. And there's three models that you can have there. The traditional model, which USDT, USDC represent, which is you hold the dollar, and for that benefit, the issuer makes the full yield. You have a second model, which is the issuer will incentivize the distribution channel, and that is very like PayPal is the biggest one. They're spending millions of dollars weekly on incentives to grow that PayPal dollar, and it's working successfully, right? Like they've grown to $1 billion of issuance. And then there's the third model, which is the one that we're working on, which is the holder is the most important person. They are the ones who should be receiving that incentive. And that is the model that Coinbase, for example, follows as well, where you deposit USDC on your Coinbase wallet and you get that 5% APY. So there's those kind of like three models. In the end, we think, of course, model one was the initial model. It started in the ZERP era. So it was kind of like 2 and 3 were not even an option. And this model has a ton of liquidity and acceptability, right? Like I can send you a USDC, a USDT mostly, and people know how to redeem that. They know how to turn it into something that they want to buy, right? Like they can buy coffee with it, like they know how to convert it. PayPal USD, not as easy. Mountain USD, even less easy, right? So the liquidity component is still something that you need to build. And that's the reason why out of the 160 billion in stablecoins, only about 1 billion of that is yield bearing, and most of it is non-yield bearing, right? Overall, I think the marginal entry in the system, especially the non-speculative person that comes in, they are more interested in the 5% than the person who's selling speculation. So I think the way the market will evolve is at 160 billion, you can have 90% non-yield bearing, but at 2 trillion, 3 trillion of stable coins, that will flip, right? Like 10, 20% will be non-yield bearing, and then 80% will be yield bearing. And Circle and Tether, I think, still have a space. They'll make a ton of money, right? Like similar like iPhone, right? iPhone has 10% of the market, but they still have 80% of the profits.
Because it's priced at a premium.
Exactly. And that premium is, we charge 20 bips or so, depending on, we don't directly charge the user, but that's kind of like their net fees versus 500, right? So you're talking about like an order of magnitude bigger fees. So, and we'll play like the Android world, right? Like more distributed, more open, and then more market share, but on the share of profits, it's going to be slightly smaller than those networks.
Okay.
So yeah, that's why would you hold it? Kind of like, obviously, if you can hold it, you would. And the big question of why not everyone is holding it is that liquidity question, which is the key challenge we're all facing.
Okay, understood. So there's a few ideas to unpack there. The first one is the CEO of Tether did an interview. He joined Tether in December of last year, I believe. And in this interview, he says, look, tokenized US dollars, as you say, crypto dollars, that is better than having your currency debased and it's digital. So that wins. Even if it doesn't bear a yield, that's better than having your currency debased at a 60 to 80% inflation rate per year, right?
Fully agree, and that's why they've been so successful. So
yeah, and I'm not laughing because I think it's funny. I'm going to Istanbul next week, and I've seen it happen. And I know the people who use crypto stuff there. I was in Argentina twice last year. It's like, it's not funny. I laugh because it's such an obvious business model. Now, the second piece is, and this is for the institutional investors who listen to this podcast. Sometimes people have asked me in the past, oh, Ether, what's it good for? Well, if you want to use the Ethereum network, you must have Ether to pay the fees. I have been saying this for 5 years.
Mm-hmm.
It's like putting gas in your car. If you want your car to go in a direction, you have to put gas in, and Ethereum is literally called gas fees. That's why you would want Ethereum, Ether, and you'd want to use the network. So there is demand for that globally because open source software, anyone can access it from cell phone if they wish, so on and so forth. Now, let's move to the piece which is around obstacles. And that is to say, the financial, regulatory, and legislative setup was created around a Westphalian system, which is nation states, which is segregated, which was actually very different to the way in which trade used to work. Go read the Silk Road book, people, if you want. I can give you the reference. Trade used to be more fluid, but then Westphalian system happens, segregate different countries, and then create separate financial systems that don't speak to one another. Now, what we're watching happen here, in my opinion, and Martin, I'd welcome you to add your thoughts. What we're watching is a global, digital, open source, permissionless set of networks open up that allow people to transact, share information with one another. But how does that mesh with the way in which these regulatory systems are set up? And I'm asking you specifically because I know you've had to navigate the Bermudian system. I used to live in Hamilton, so I understand.
You know you very well. Yeah.
Yeah, so maybe I'm talking too much. So I leave it to
No,
you
no,
to
but
kind of trace that out because you've got the experience and it's really interesting.
yeah. So you're spot on, right? Like each country has set up their rules on like how to manage money and how to like what is their economy going to be exposed to, right? So you have controls on money and regulations around money, but also controls around goods, and those two things are kind of highly connected. Crypto comes in, and suddenly you have it's like Swift became the APIs became open, right? And anyone can connect to that. I think that's a good way of thinking about it. If you're not a crypto person, it's like you can go and start sending money through Swift, and suddenly I can send a payment to someone else, and the network doesn't even know which country you're on, right? Like I just see your public address.
Yeah.
And that starts opening a bunch of questions around remittances, around flows of funds, and so on. In my personal opinion, I think it's more freedom. Being on the other side of those regulations, and my family still being on the other side of those regulations, when you are the restricted party, it is not a very happy place. And like you said at the beginning, right, like facing that 40-80% inflation, Argentina Q4 last year had 300% inflation, right? So your money is literally being burned as you hold it in your wallet. It's not a happy place to be on the other side of that regulation. So I very much welcome the ability for people to transact with their money. And then the argument always comes, okay, but what about compliance, right? What about terrorism and money laundering, right? Like those two topics. And my answer always is, criminals don't like using crypto, right? The only criminals that use crypto, it's very easy to trace, right? And so the compliance question is answered. Many people see that and they're like, okay, this is a tool for freedom. In what ways? I think the most important is for the unbanked. And the unbanked don't exist because they don't want to open a bank account. The unbanked don't exist because banks suddenly ignore a segment of the population. The unbanked exists because it's not profitable to serve them.
Correct.
And why is that? Is if you run a bank in the US, you spend $1 to $2 per retail account per month in operations and compliance. If your customer doesn't generate $15 to $20 in revenue per year, it is not profitable to serve them.
Mhm.
And the unbanked don't have deposits to offset that. And if they're too risky to lend, you might as well not open an account. Now, let's take that to Africa, right?
Okay.
If someone is going to hold $3 in your bank account, you're never going to be able to make $1 per month to serve them. And that's why Africa is highly unbanked, or Argentina, or so on. So crypto offers suddenly an amazing low-cost solution to bank the world, because instead of having people going through papers, you have software going through transactions, and you're doing way better compliance. So I think it's just a revolution where we have the top of the pyramid has had access to banking, and the rest of the world was relegated because the economics didn't work. And suddenly crypto is changing those economic laws, and everyone now has access to that. Some regulators see that. Bermuda sees that. Abu Dhabi sees that. In some lower extent, I think Europe also sees that. Many places still don't see that. And that's why you see crypto regulation. It is a hard topic to understand because it's very new, it's very nuanced. Particularly around like navigating this. Of course, it is very complex, right? And the way we think about it is, how do we make sure we're going through first principles in the right way, and we're doing things right? And how do we ensure the most important thing, which is customer protection, right? How do we ensure that our customers, when they come with a USDM, they can actually get $1 back? And if you're talking about this person that makes $200 a month and they spend $5 buying USDM, those $5 mean a lot. How do you make sure those $5 are protected? And that's where regulation, I think, is very important, because we know about this agency problem in banking, right? If you take risk, you get the bonus, but whenever that risk materializes, it's the depositor's problem. And we've seen that in several occasions, and that's why regulation exists. And that's why we went down the process of actually being regulated, because you need someone strong to say what you're doing is right, what you're doing is not right, and being able to actually pull off a license, or even if you commit fraud, can like put you into jail, right? Like you want to expose yourself to that type of very strong supervision. Particularly, particularly in Bermuda, they do understand this, right? Like they spent the TABA Act passed in 2018, and they've been working, educating themselves. They've exposed themselves to a lot of vendors, to a lot of projects. And if you see the quality of the projects that are getting licensed in Bermuda is insane, right? Like new projects like us, but then most of the major players in the industry. Coinbase, Kraken recently got a license. Zero Hash, Hashkey, XBTO. The quality of players going there is great because they've clarified what the rules are and are willing to hold you up to those rules. So I think the Bermuda license is today the strongest license a crypto company can have. And unfortunately, and I think maybe I want your opinion on this, but Bermuda, it's an island that starts with a B. And we had another island that starts with a B, where in 2022, a big exchange exploded called Bahamas. And
Nassau.
Lots
Nassau
of people
be the home of Pirate Republic. Like
and lots of people confuse the two, and they think, oh, you're regulated in Bahamas. They think about if FTX was allowed to be there, why is Mountain not an FTX?
Totally different.
So, and one of the challenges we have is explaining that difference, right?
Most people don't know that Bermuda is actually, if you go from Washington, D.C. and fly 2 hours directly east, they think it's in the Caribbean. Like, no. And it's a British protectorate as well. So it's part of the Dominion. I say this coming from London. So yes, it's a whole thing. Yes, I've lived in Hamilton, worked with insurance companies. They will listen. And they can be quite informed, and that's obviously what's happened. You've unearthed a few ideas, though, so I'm going to riff a little bit.
Let's do it.
You mentioned the unbanked. Now, when I was a grad student, I was the teaching assistant in a class called microfinance. And at this time, it was 10 to 12 years ago, and I was like, Bitcoin. Ethereum hadn't yet been released, but the second piece, starting my career, and I'm sorry I'm talking a bit about myself, but it helps show that I understand what you're saying, and I think you're correct. When I started my career, I was at the OECD in Paris, and I was working in the Center for Entrepreneurship, Small and Medium Enterprises. And one of the big problems was like nobody will lend to small businesses. They don't want to do the due diligence. It's too expensive given the revenue, underserved market, right? So those two little anecdotes, and I could go on all day, show exactly why this is a disruptive innovation, as Clayton Christensen would say, that it's an underserved part of the market, lower down the market in terms of margins, but because the technology's there and the people possess ways in which to use and access technology, basically the market gets invaded from the bottom up.
Exactly. And that's how
So
disruption happens, bottom up.
absolutely, that's exactly how disruptive innovations invade a market and then eventually take over. And we're watching it happen. It's utterly fascinating. The kind of countervailing force is that there are regulations in place that are adapted to old system and infrastructure. That's not to say that the regulations are bad. That is to say that they may be a bit out of date and need to be updated. But if the goal is to make sure, as you said, that people have safe, secure, reliable, accessible financial services, that's meant to be the goal. So it's fascinating to watch, and you've had to navigate it at Mountain Protocol, how to do that given this new technology. So I just find it fascinating what you've done, and it's just one day someone might write one of these Harvard Business Review case studies on
Let's
it, or
hope.
maybe I'll write it for you.
And we continue to navigate it, right? So if you don't come from a regulated space, it's very hard to understand what being regulated means, right?
Mhm.
So just to put some color there, what does regulation mean? So you have pre-licensing. You have to show what your business is going to be, how you're going to conduct your business, who are going to be your business partners, vet those business partners, like anyone who's going to touch a dollar or anyone who's in the flow of funds and can lose that dollar. So it could be your custodian. It is also your custody solution, aka Fireblocks. It's how you're going to manage the smart contract, all of that.
Yes.
But then on top of that, you have how are you controlling that operation?
Yes.
What is your cadence for governance? How are officers being communicated? How are you minuting those minutes in case you're going to get audited, because the audits are going to happen afterwards? You're going to have your compliance committee, risk committee, audit committee, your board of directors, which need to be majority independent. And then you have your outside review on what you're conducting in the business. So you have your risk audit, so reviewing all of the processes. Are you managing risk correctly? Are you mitigating the risk? What are the factors mitigating that risk? You have your compliance audit, obviously, because we're moving money. And then you have your financial audit. And then on top of that, you have the regulator looking at all of those pieces of information and anything else they might find, and jumping in where necessary to explore how are things being conducted. So it's an ongoing thing. We have risk meetings every month with external directors. We have quarterly audit and compliance committees and board of director meetings, and then annual audits. It is a lot of work to be regulated, because you not only have to do things right, you have to show the second barrier of defense and the third barrier of defense that you're doing things right. So it's you do, but then you verify twice, and then you show it to the regulator to ensure that what you're doing is actually right. And that's how you check it. You have to be checking more often than you're doing. So it turns your company a little bit slower. And for us, it's an art of how to manage that regulation. But once you've seen it and you look at other people operating and kind of shipping to production immediately, or those types of things, when you're touching money, I get goosebumps when I kind of see that. And it is really a differentiator. Having a serious regulator that actually asks for all of this, really changes the quality of the product. And I think that's an underappreciated aspect in like with the crypto natives, because I would say almost none of them have come from this regulated environment, so they don't know what that means, right? So they verify the smart contract very deeply because most of them are developers, but the smart contract for real world assets like either stable coins or tokenized T-bills or tokenized or whatever is the easy part. It's in standard ERC20.
Yes.
The hard part is the governance below it and the operation. Yeah. So yeah, I think that's a part that I think as more sophisticated players get in, this is going to become even more important. But today, like, we overestimated how much that the regulation would serve us. Most people don't even understand what the regulation even means, right? Like, they see a regulation from Bermuda. If it's not coming from the US, they completely dismiss it immediately as, okay, you're in the same ground as everyone else who's not regulated, which I found surprising coming from that regulated space. So now I understand why, but my hypothesis was that it was going to be a lot more powerful.
The thing I take away, and I'm sorry we're coming up on time, but what I take away from what you've just said is I've had kind of a thesis or hypothesis for a number of years, which was and still is that the traditional finance space and this kind of crypto DeFi thing are going to mesh. And basically, one will take the benefits of regulated financial services provider with experience, so provide something that's safe, secure, transparent, mix it with new technology, which has to be managed correctly, as you said, like smart contract audits. And let me tell you, like, that's a big part of my current schedule, which is making sure they're done correctly, right? So
they're done. Yeah.
But when you put the two together, what do you end up with? You end up with something that's got the best of both worlds, and things just kind of roll forward, and it creates opportunities that are win-win for people. You don't end up with a bunch of people in the Bahamas in Nassau, ex-pirate republic capital, doing silly things. No. Like, we're doing things correctly, and we're using best practices from traditional finance, and we're also using new technology that people want to use because we already see them using it, right?
Exactly.
Which you know, because that's what your company's based on, Mountain Protocol. We are coming up on time, though. So usually we finish episodes by talking a bit about the future. That is to say, what interests you. It can be about tokenized T-bills, Mountain Protocol. It could be about tokenizing assets more generally, or it could be about the way in which this technology is evolving. I leave it to you, for the listeners' benefit, to say what you think's interesting, because whatever you, given how close you are to the matter, is probably interesting.
So I'm very close to the metal on stablecoins. So I think the stablecoin play, people say it's the product market fit of crypto, and I agree. But I think the stablecoin meta has not even started playing out. I think we're all watching the US regulation on stablecoins, because until you have that, like, stablecoins are all dollars, and the dollars, no matter where you have them, are in the end regulated by a correspondent bank in the US. Okay. So the US perspective on stablecoins for dollar stablecoins is critical. And until that happens, I think the space is still going to be small. When that happens, I think we're going to see several orders of magnitude expansion on the stablecoin market. Today, the players in stablecoins are my grandma, your cousin, someone's uncle, right? It's all retail, and it's like a small portion of retail who are in the frontier exploring. It is not the mass of retail, and it's definitely not the institutions, right? Most institutions are still asking the question, how do I treat this? Is it cash? What does IFRS say about this?
What is it? Like,
exactly.
What's Ethereum?
And what's Ethereum? How do I do compliance on this asset? How do I put it in my balance sheet? Is it on or off balance sheet? Do I have to pay taxes? Do I do the primary market or the secondary market price? There's so many questions that are still unanswered. I think the moment that you answer those questions and you give clarity to companies like, hey, you can leave SWIFT away and just use stablecoins. You can leave out ACH wire and you can just use stablecoins that just manage everything on crypto. I think we're going to see an explosion. And this is an explosion because it's A, cheaper, but B, the access is a lot better. And the way I think about the market is, if you look at the M2 in the world, like the total money supply, there's like 140 trillion. Out of that, 20 is US dollars and 120 is everything else. Out of those 20, 10, give or take, are in the US and 10 are outside. So give or take, you could say the US has like roughly 10%. The dollar has 10% market share of the non-US money supply, right?
Yes.
And that is with, how easy is it to open a dollar bank account if you're in Argentina? Let me tell you, it's impossible. If you're in Turkey, it's almost impossible. Like, unless you're a very big company and you have a private banker, it is very hard to actually do. And if you all do it, you are still facing a dollar liability of a Turkish bank, not a US custodian holding T-bills. So like, these companies are not holding substantial dollars. And even with all of that, it is 10% of the offshore money supply. Now imagine you put crypto into it. Could we get to 20%? Could we get to 30, 50%? I don't know. Let's assume it's just 10. Like, we double the market penetration of dollars in the offshore M2. You're talking about $10 trillion in stablecoins. 10 trillion out of 160. So you're talking 2 orders of magnitude.
That's an addressable market.
I think it's going to happen very quickly. Like, the moment that regulation passes, you have clarity. You can now start switching. You take your boot off your neck in terms of accessing banking, accessing a bunch of services. Big audit firms don't want to audit crypto companies. Like, the whole ecosystem kind of changes their perception to crypto. Choke point is harder to do when you have this clarity. I think people are not ready for that, because it is not something that's going to happen tomorrow. It is not a meta that's going to happen tomorrow. But the US has to do this, because someone needs to buy the US treasuries. And there is a massive potential buyer in stablecoins. We're raising our hand like, hey, give us regulation, we'll buy 10 trillion. So I think it's going to happen. Is it 2025, 2026, 2027? We don't know. I think it's going to happen earlier than later. And I think it's going to expand our addressable market by several orders of magnitude. And looking back, it's going to be like, it was so obvious. Like, how much more do you buy if you have Amazon than going to a retail shop? Like, a lot more, right? Stablecoins are like the Amazon. Going to a bank, filling 20 papers, them telling no unless your minimum deposit is above X. That is going to the store, right? So that is what excites me. That's what I'm tracking. And I think once you have money on chain, a bunch of things become possible, or grow their market as well, right? So it's a rising tide that lifts a bunch of boats, but this is the tide that I'm watching.
It's somewhat ironic that a lot of this was rooted in the Bitcoin kind of cypherpunk thing, which is, we're going to have a digital currency, in inverted commas. We're not going to debate whether it's a currency or not. But the idea was, no one's going to control it. Everyone can participate. And then it evolves into the system where, as you say, like the stablecoin thing, which is US dollars that are tokenized, becomes wildly popular, if only because in competition between currencies, and I've got a book here about the Birmingham buttons, which I'm not going to pull off the shelf now, but the idea of currencies competing against one another is historically there's precedent, right? We also know about private banks in the US prior to around 1870 issuing their own private currencies. So this is something that happens. It's a bit ironic, because it turns out tons of people want US dollars because other people want US dollars. And if they want to exchange them via cell phones using public key cryptography and open source software and distributed network, like, they'll do it. And they're already doing it. I'll have to tell you when I go to Istanbul next week again what happens, because that's already
the market
happened.
is
You're
insane.
from Argentina, so you know.
Yeah, and I went to the big bazaar, and you see it, right? Like, you see, I saw the videos of the 90s, and they were all carrying tons of cash. And now you see them with cash, obviously, but they also are using their phones. So you can see, I don't know if they're, like, I didn't approach them to see if it was MetaMask what they were using, but they are exchanging digital cash as well.
Hey, the listeners already know, I've said it twice in previous episodes. I have been asked many times in Turkey, cash card or crypto, how do you want to pay? And
Love
they
it.
accept USDT via Binance. So there you go. Anyway, we're on time, Martin. It's been really nice to have you here. Thank you. We'll have to get you back again because the work you're doing with Mountain Protocol is fascinating. I know it's hard to build a business. I've had to do it before.
Yeah.
But it's really impressive what you folks are doing. How can people find you on the interwebs?
Yeah, so my personal Twitter at mcarrica, and I post there mostly about stablecoins, but in general other things that I find interesting. A lot of stuff around Argentina as well. I'm very excited with what's happening with Milei and so on. And then the company mountainprotocol.com or at mountainusdm on Twitter or on X, and docs.mountainprotocol.com to see kind of like the description of everything that we've built. We disclose everything that we do, so you can go as deep as you want.
Excellent. Well, there you go, listeners. Martin Carrica, it's been a pleasure to have you here. I hope to speak to you again very soon.
Awesome. Thank you, Ben, for having me.
There you have it, folks. Martin Carrica, founder at Mountain Protocol. I hope you enjoyed the discussion today. It's absolutely fascinating to watch this market grow and evolve. US listeners, wisdomtreeprime.com, Apple, Android app stores, Bird app. I'm on it too much. You can find me there, and we can debate things on the internet at Benjamin Dean. Thank you for joining us. It's really nice to have you here. I hope you found it informative and useful, and I look forward to having you again next time.